Hello, and welcome to the BioSyent Q3 2016 results presentation. My name is Rene Gorham, and I'm the Chairman, President, and CEO of BioSyent. I want to start today's presentation with a look at our sales, EBITDA, and net income after tax for the quarter ended September 30th. So we achieved a record quarter of sales at $4.767 million. That was up 3% versus a year ago, but competing against a strong comparable period in Q3 of 2015 with a large FairMax international order. I'll speak to that in a couple of minutes. Our EBITDA reached $1.647 million, up 2% versus a year ago, and net income after tax was up 5% to $1.247 million. So on the impact of our FairMax international business. So if you've been following us for a few years, you know that we started in 2013 shipping FairMax to international customers, and that business has been growing steadily and in fact quite sharply ever since. So last year we had a large order, $627,000 to one customer that shipped in the third quarter, and that is part of the comparable that we are working against in the September 30th quarter. So we've now received orders and in fact have started manufacturing and shipping orders for a total of $756,000. So this will now be fourth quarter of 2016 will now be our new record for international shipping. When we deliver those orders, our total year sales will reach $1.8 million. Which will represent a 58% increase over $1.1 million last year. And just to give a little bit of perspective and kind of what the order book looks like, last year we more than doubled the business on a full year basis. This year up 58%, and we continue to see strong growth in that business going forward. Including the allowance for the strong comparable, the international business is up 8% through 9 months. Though the quarter was down versus last year, it exceeded the sum of both Q1 and Q2 put together. So on a 9-month basis, our sales reached $12.9 million, up 12% versus a year ago. You can see if you look back over the last couple of years, our compound growth rate using 2014 as the benchmark year is up 19% compound over the last couple of years. To look back at our trailing 12-month revenue, you can see we're up 15% versus the prior year trailing 12 months. Our EBITDA reached $4.3 million, up 5% versus a year ago, and our net income after tax just over $3.2 million, 7% ahead of the year ago period. So let's take a look at the Q3 and the 9-month growth drivers. Our Canadian pharmaceutical business sales in the quarter reached just over $3.6 million, an increase of 10% over a year ago, and on a 9-month basis up 11% versus 2015. You can see that FairMax powder, Cathogel, and Repagine were all significant contributors, though FairMax 150 less on a percent basis growth, that is, but it is a significant business for us, and therefore any growth is a significant dollar contributor. You can see that FairMax powder sales volumes measured in units were up 42% in the quarter and 31% on a YTD basis versus 2015. Cathogel jelly up 28% in Q3, 14% for the YTD period. We have seen an acceleration not just in the quarter but after the quarter end, an acceleration in our Cathogel business. And Repagine has been a steady grower for us all year. It increased 55% in the quarter versus year ago units and is up 88% YTD over 2015. So just a couple more comments on the international FairMax business. So what I have described as a lumpy business in the past has now become a consistent business, though still lumpy. We now have sales in 7 consecutive quarters to international customers. We've added customers to our list of customers that we're shipping to. Based on the order book that I described, and we expect to get out the door before year end, the international FairMax business will represent about 10% of total corporate sales this year in 2016. It's also interesting to note that our operating expenses on the international business are significantly lower than our Canadian pharma business, in that our partners do all of the regulatory promotion and distribution work that we undertake here in Canada for our Canadian business. We also have a lower tax rate on our international sales, certainly versus our Canadian pharma business, and in essence generate more net income after tax as a result. So looking back at the last 20 quarters of our pharma business, you can continue to see a steady growth. Of course, as I mentioned before, we had a record quarter. This also translated to our pharma business. It was a record quarter. You can see in this graphic that we've got that large shipment to an international customer in the year ago period. The tops of those quarter results you can see as international sales. I said the last 7 quarters we've shipped, and that would be 8 of the last 9 quarters. Where it was a sporadic business in the past, has now become quite a steady revenue stream for us. A couple comments about activity during the quarter and subsequent to the end of the quarter. In September, BioSyent was named to the Profit 500 ranking of Canada's fastest growing companies for the 4th consecutive year. The measured period was the 5 years ending 2015. Our growth rate was 815% over that period of time. A couple of weeks ago, we announced a new product in-licensing and supply agreement for a new women's health product. This is a prescription product that will compete in a market segment in Canada that's valued by IMS at about $200 million. In the measured period, I believe ending June 30th, it had an annualized growth rate of 5%. Of note here is that this is entirely complementary to our existing products, Ferramax and Repagyne. We're calling on those doctors. We've been building relationships with those doctors now for years, and this product will fit very nicely into this portfolio when it's approved by Health Canada. Finally, we launched a new Agaton system prefilled syringe product, phenylephrine hydrochloride. We announced back in the spring that the product had been approved by Health Canada. We started shipping against customer orders last week and have had very positive response from customers who have already been adopting our first Agaton prefilled syringe product. So as a result, we have no incremental selling and marketing expenses against this product launch. So taking a look at our key growth drivers, both for the 4th quarter and beyond into 2017 and into the future, quite frankly, we've got a number of products that are still driving near-term growth. That'd be Ferramax in Canada, Ferramax to existing international customers, our Repagyne business, Cathogel, and now the Agaton system. We have new products, both new products that are coming to market and will be going through a regulatory process. I'll start with a few comments about Cysview. As you know, we in-licensed Cysview last year. We introduced it to the market late in the year and have been busy laying the foundation for successful business in this area. We estimate now that we've got over 15 hospital sites that have either done a trial with the product or have scheduled a trial or in the process of scheduling a trial. Though this is in line with our expectation, we thought that we would have a few of them having adopted by now. I would estimate that we're kind of 3 to 6 months behind the curve. The encouragement that you can take from this is the feedback that we're getting is very strong, and we have customers that are just going through the equipment acquisition process and making sure that they can integrate both the equipment and Cysview into their clinical operations in the hospitals. But the revenue contribution of this product is negligible in the results you see here to date. So we see this as going to be a significant revenue driver as we move forward. We are also working on adding additional international markets for our Ferramax franchise. We have a regulatory process underway and expect to be adding new markets to our revenue generating customers in 2017 and beyond. And then, as I've said, we've got new products that are going through the Health Canada approval process, the 2 cardiovascular products that we announced in licensing earlier this year, and the women's health product that I mentioned a few moments ago that we in-licensed a couple of weeks back. We continue to have a very active deal funnel. You should expect to be hearing from us more in the coming months on new product initiatives. Let's take a quick look at our balance sheet. Of note, our working capital now is up 29% in the 9 months since the end of last year. Our cash and short-term investments now total $11.4 million, at least did on September the 30th. That's up 17% from December 31st. We had an increase in cash and short-term investments in the YTD period that was 328% ahead of a year ago. We continue to be a strong cash generator and have no short-term or long-term debt on our balance sheet. So I did want to take a moment to talk about our cash position and our cash generation. As you can see on this slide, our cash position has grown by about $5 million over the last 24 months, the 24 months ended September 30th of 2016. As I mentioned a moment ago, we're strong generators of cash. You can see our 9-month generation at just under 1.7 million. You know, that begs the obvious question, how are you going to make productive use of that capital? And I can tell you that we're looking at several opportunities that will deliver shareholder returns. We are focused currently and will be focused moving forward at looking at opportunities to deploy that cash to further accelerate shareholder returns. So let's take a look at our return on equity, as our cash position plays into that story as well. So you'll be familiar with this slide. This shows our return on equity going back to 2010. Since a very sharp peak in 2012, our return on equity position has been coming down. It is in the 12 months TTM September 30th was 31%. Another way to look at this is what is our return on equity net of cash. So if you take non-productive cash out of the calculation, you see that our ROE net of cash is 117%. As we go forward and we look for ways to deploy the capital in ways that will accelerate our growth and our profitability, that would be a good way to look at what we're delivering now on ROE. Quick look at our earnings per share. You can see in the Q3 of 2016 we earned 8 cents. That compares on rounded to the same number as last year, 8 cents. Last 12 months, 27 cents versus 26 cents a year ago. Quick look at our stock situation, shares outstanding, options. Those that have been watching us can see that there hasn't been much of a change there. We haven't issued any new equity in our company since 2002. I'd like to thank you for your continued interest and support in BioSyent. If you wanted to get any more information on any of our products, we have a number of product websites, and of course our corporate website, bioscient.com. We look forward to reporting to you in the coming quarter on a strong finish to 2016 and a number of other initiatives. Thanks.